All right, so there is more news and data coming out to us here in the housing market today. And this is data that doesn't necessarily suggest that we're going to have a housing market crash similar to what we saw in 2008. In fact, in my opinion, it's the opposite. And I'm going to go through this data, give you some feedback here along the way. So we have up on the screen a report from Black Knight, and it's called the Mortgage Monitor. And they do this every single month, and it's just packed with all sorts of really great data. They do a high-level overview of what's going on in the mortgage industry, interest rate trends, housing market trends, and even delinquency. So let's go ahead and just jump right into it here. The first slide is going to be the mortgage performance overview, and it talks about mortgage delinquencies and foreclosure starts here. So we can see the delinquency rate is actually up about 2 basis points. And if you look at the fine print here, it says June delinquency rate inched up, but still remains near record lows. And I'm going to show you a chart in a second which actually depicts that, and I think it's going to really provide some good context. It also says that foreclosure starts are up 10.3%, which is a rather large jump. But again, is that the whole story here? So let's take a look at what that means here on a chart and kind of just talk through it a little bit. So now you have the national delinquency rate here for first lien mortgages, and then you have it broken down in a chart that goes back to 2015. This blue line is going to be your delinquency rate. And then this green line here is going to be the average delinquency rate that we saw between the year 2000 and 2005. And so you can see here right around, let's say, June of 2020, right after the pandemic pretty much ensued, we saw the delinquency rate of mortgages spike up drastically, hitting kind of a record high there for the last 8 years. But since then, that number of delinquencies has actually gone down dramatically, and we're still sitting at an all-time record low, or at least near a record low at 3.12%. And then if you take a look at that average between the year 2000 and 2005, it's sitting at 4.27%, which was also a time when mortgage foreclosures, or at least delinquencies, were really low leading into the GFC. And so we're still hovering under that, and a lot of that has to do with obviously having fixed rate mortgages and having to prove the ability to repay. Now on the right-hand side here, this is the mortgage delinquencies by severity, and this just breaks down the number of days that a borrower is delinquent. So 30 days, 60 days, 90 days, or more. And if we take a look at the 30 days past due, you can still see, that's less than 1 million borrowers. And even though it's up maybe slightly, it's still sitting at historic lows dating back to the year 2000. And you could see this large run up leading into the great financial crisis. That's when delinquencies peaked, probably sometime here in June of 2010. And so you can see that a lot of these properties went more than 90 days past due, total delinquency rate spiked, and that's when we started to see a lot of the foreclosures. So back then, it was a combination of multiple things, but we had subprime loans for borrowers who had subpar credit. We had stated income loans, stated asset loans. There was a variety of products available. We even had something called a negative amortization loan back then, where if the borrower made the minimum monthly payment, that the balance would actually increase each month rather than staying the same or going down. And we just don't have a lot of those products available here today. And so the large spike up that we did see more in the more recent years with regards to delinquencies was just right after the pandemic, and now those levels have normalized and they're still sitting at all-time record, and they've sort of worked their way back down to all-time record lows. So for those of you who think there may be a large foreclosure crisis coming, this chart sort of tells a different story in my view. Now, the one thing that I really want to mention here is that the foreclosure process takes several months, if not even a year or two in some cases, to unfold. So when mortgages start to go delinquent, it's not like those loans and those borrowers automatically go into foreclosure. In fact, in many cases, they have several different options. And these lenders and the government now has a playbook for what to do when these events start to unfold. And that playbook was really built in 2008 when we experienced the GFC. And so there's several different options. And I think this chart is a good representation of the composition of those different choices and options that actually take place. So we have here foreclosure protections on seriously delinquent. So this is anything 90 days plus. and a couple different options or items that give a borrower or a homeowner some protection. So we start with the baseline here, which is at the bottom. This is someone who maybe has zero protection from foreclosure. And you can see this is a relatively small sliver in this chart. And it stayed relatively consistent here over the last few years. Now, in green, this is actually forbearance. And this became very common when the pandemic took place right as of March of 2020, because we saw all of these serious delinquencies spike like we witnessed in that previous chart. So what a lot of these lenders did is they had borrowers go on their websites and express that they were in some sort of financial hardship, and they deferred mortgage payments. Now, later on, they had to modify those loans and ultimately tack in those missed payments onto the balance of those loans. But that didn't happen in every single case. And you can see that even though we saw this major spike in forbearances, it has now tapered off. Now, for borrowers who go into loss mitigation, what they're essentially trying to do is modify the existing terms of their mortgage. So let's say they had a mortgage that was at 5% and they went seriously delinquent on that loan. And let's say the reason that happened is because they had a job loss. Well, they go back to the lender. Let's say they found employment again, and now they're able to start paying their mortgage, but they aren't able to bring it current from everything that was past due. So a lot of times the lenders put you into loss mitigation. They try to work out a payment plan and readjust your loan terms. Somebody who has gone seriously delinquent, their credit is probably taken a really big hit too. And so they're not able to refinance like a borrower who has, let's say, excellent credit and never missed a payment. So in a lot of cases, they will modify the loan based on your new income level and your ability to repay, which in some cases means that they will actually reduce the rate and modify the existing terms, sometimes even out to extending your loan term up to 40 years, so that the borrower and homeowner can stay in that property. And then you have a small percentage of homeowners that have actually gone into bankruptcy as well. Now, generally this just delays foreclosure. It doesn't stop it altogether. Right, and on the next slide here, this actually shows total foreclosures. And I'm not gonna talk too much about this, but you can see historically how we're looking today versus where we were, let's say 25 years ago, and where we were in the great financial crisis. So right now, we're sitting at basically an all-time record low. And I guess the point of me bringing all of this up is that even though we're starting to see numbers out there that look slightly shocking, they're like, oh, mortgage delinquencies are up a couple points, or foreclosure starts are up 10%, even though those seem like relatively large numbers, if you zoom out in the macro, we're still looking at relatively small amount of foreclosures. Let's go ahead and switch gears a little bit, and we're gonna be talking more about where interest rates are and the ability to repay, like where we're seeing debt ratios today. And this chart here, this is gonna be the unpaid principal balance and current interest rates on outstanding mortgages. And I think you'll find this really fascinating, at least I did. We have the average unpaid principal balance dating back about 20 years here. That's the blue line. You can see the average 23 years ago was sitting just about 100,000. And as of today, we're sitting at an all-time record high of the average unpaid principal balance at about 242,000. So mortgage debt is the highest it's ever been. However, the average interest rate on these loans is actually still sub 4%. Now, to me, what's fascinating is this trend here. If you go back 23 years, you can see that the average interest rate was substantially higher. It was about 7.5%, nearly 8%. And then you saw the loan balance significantly less. Now, we're starting to see mortgage rates go up. The average today is at about 7%, but we have not seen prices come down yet. So my suspicion is that moving into the future, we're probably going to see this chart go up, even though it may take several years to unfold. Because you got to remember, a lot of people that have secured debt that's sub 4%, they're really not incentivized at this point to move up or trade their property for another property because they know they'd be giving up an all-time record low interest rate. So it's going to take several years for potential home buyers to go out into the marketplace, secure new mortgages to go ahead and bring that average up. And then this chart here on the right, I thought was really kind of interesting as well. So we have principal and interest payments on outstanding mortgages. The blue line is going to be your average payment. So this is excluding the taxes. And you can see here that we're hovering at not necessarily a record high, but we are approaching the levels that we saw in '08 and '09. Now, I don't know whether or not this is adjusted for inflation or in real terms here, but that is interesting. I actually would have guessed that that would be higher today. And then right here in the green line, you actually have the average payment as a percentage of median household income. And what you'll notice is that we're sitting at about a record low. So for the most part, the average payment as a percentage of median household income is really sitting at about 22%. Which in most cases, for many people, that would actually be very affordable. And you could see where it peaked out in 2009, we were sitting at, let's see, just over 35%. All right, this is one of the charts that I actually like to pay really close attention to. And I've actually shown this on prior videos, but just using Fred data. What it is you have your 30-year fixed rate mortgage here in green. That's the average 30-year fixed rate mortgage. And then you have in blue the 10-year treasury yield. And for those of you who are not aware, mortgage rates tend to follow the 10-year treasury yield relatively closely. So when it goes up, rates generally go up. When it goes down, rates generally go down. And what you'll notice is that the spread between this 10-year treasury yield and the 30-year fixed rate mortgage remains historically very wide. Now, this spread generally widens for a variety of factors, and a lot of it has to do with rate volatility that we're seeing in the marketplace, along with prepayment risk of current originations. You go back and look at this data historically, the spread is typically gonna be sub 2%. But as of right now, we have the 10-year treasury yield sitting at about 4%, while the average 30-year fixed rate is sitting at 7%. So the spread is 3%, which is pretty high right now. And as inflation calms down, as some of the rate volatility calms down, I suspect that this gap will be narrowed and hopefully we'll see a little bit of a reprieve in mortgage rates. This one is the average credit score. This is for purchases of primary residence, and it breaks it down between investors. So conforming loans, FHA loans, and then VA loans. Now, on the left-hand side is going to be your conforming, and you can see here, if we just sort of were to pretend to draw a line back, the average credit score for a conforming loan is sitting at about 755, which is a historic high. So the borrowers that are buying homes today using a conforming loan are very well qualified as far as credit is concerned. FHA credit scores have historically gone up as well, but the average is sitting just under 680, while the VA borrower, the veteran borrower, those have also trended up over the last 5 years. So scores are improving all the way around, which means that borrowers are becoming a little bit better qualified, or at least those are the home buyers or potential home buyers that are purchasing today. So VA average credit score is just under 720. Now, on the right-hand side, we have the average debt-to-income ratios for purchases of primary residences as well, and they break it down the exact same way. So by the actual loan type, so conforming FHA, non-conforming, which would be like your jumbo products, and then your VA loans. And we'll start with the non-conforming. That's your jumbo product on the bottom. And what you'll see here is this has historically stayed relatively stable. These are going to be your exceptionally well-qualified borrowers in most cases, which is why their debt ratios are generally going to be very low. We're sitting at about the average right now, which is, let's say, between 31 to 33%. And a lot of times these are going to be your self-employed borrowers, business owners. They have very high incomes and they're usually taking out loans that are above the conforming limit. Now, the conforming limit today is $726,000. So you can imagine anything that falls into this bucket for the most part is going to be north of $726,000. So you're talking about really sizable loans, which means that for the most part, borrowers have to be very well qualified in order to secure that kind of financing. Then you have your conforming loans here. You can see that they have gone up a little bit. We're about the highest level we've been in the last 5 years. The average debt ratio is sitting at about 37%. So you're still less than 40% of gross income is going towards housing, which is not too bad historically speaking. But where it really gets interesting and starts to get a little more dicey, in my opinion, is the government products. Both FHA in green and VA, they are over 43%, approaching 45%. And the reason why this frightens me just a little bit is because typically with these types of mortgage products, borrowers will only put either 0 or 3.5% down. Like VA loans, you can technically purchase with 0 down. You still have closing costs, so there's funds required to close. But you could technically do a 0% down payment, which means that a borrower would not have much equity in the property at the time that they actually purchase. And so if the home values were to go down, they become upside down in that mortgage, meaning they owe more than the property's worth almost immediately. In fact, you could probably argue that they're upside down in the property from day one, because generally speaking, to exit a property to sell, you're going to have 5 to 7% in closing costs. So if you don't have at least 10% equity in the home, could put you in a bad position if something changes with regards to income. And that brings me to the next screen, which is really a reflection of down payments. So how much is owed on a property versus what it's worth on purchases of primary residence. And you can see that the loan to value has actually gone down, meaning borrowers in general have more equity today at the time of purchase. We're currently sitting at about an 84.5% loan to value, which means there's about 15% equity in these properties. So the way I read this, since it is on new purchase rate locks, is that borrowers are having to put more money down to bring their payment into a more affordable level due to the higher mortgage rates that we're currently seeing in today's housing market. Now, I think this is just overall average for the marketplace, but if you go to the right here, you can see the average down payment broken down by investor type. Conforming loans have a significantly higher down payment than they've had over the last several years. VA loan here and the FHA loans, they're also sitting at higher down payments than they have previously. And these products are going to be lower down payment loans like I mentioned. So my guess is that the increase that we're seeing here today is also due to the fact that home prices are still hovering at record highs. I know they're off their peak slightly from the peak that we saw in 2022, but the supply constraints that we're seeing in the market is still keeping these prices relatively stable. All right, and this last slide is going to show the most affordable housing markets and the least affordable housing markets. Most affordable housing markets, we have Cleveland, Pittsburgh, Oklahoma, Hartford, St. Louis, Cincinnati, Detroit, Indianapolis, Chicago, and Minneapolis. And then you can see that the payment ratios are all sitting in the right at about 25%. And if you look back at the average between 1995 to 2003, you could see there's not a significant difference. It's all single digit gains. So housing has gotten more expensive, but these areas are certainly what we would consider more of a linear market. They're more affordable and they've stayed more consistent over time. These are the least affordable markets here as well. We have Nashville, which I actually think was interesting because I know this was a relatively affordable market that investors really flooded into over the last few years. We also saw a lot of migration in from some of the higher priced markets into Nashville, Tennessee. I know a lot of people migrated and moved over there, but you can see that the payment ratios have gone up substantially over the last 20 years. They're currently sitting at about 40%, whereas the average 20 years ago was at about 23%. So it's a significant jump. And it just means that these housing prices combined with current mortgage rates have disconnected quite significantly from the local wages. Sacramento is on this list among other cities there in California, no surprise. Sacramento is actually my market. It is very expensive. It started to come down in price slightly, but we seem to have found a bit of a bottom. And so they're staying really stable. Even though prices have come down, they've sort of rebounded in the last couple months. So we'll have to continue to monitor that. We have Riverside, Seattle, New York, Miami, San Francisco, San Jose, San Diego, and Los Angeles. Now, historically, these have always been higher priced areas, at least over the last 25 years. But you can see, I mean, look at Los Angeles, a 68.9% payment to income ratio. I mean, could you even imagine that? Like, how is that even possible? I'm honestly not even sure. All right, so that was a deep dive into the Mortgage Monitor report. I hope you found this information useful. If you are new to the channel, I would be so grateful if you hit that like button. If you subscribed, feel free to leave a comment below. Would love to hear from you, and we will see you on the next video. Thank you so much. Take care.